Hello, everyone, and welcome. My name is Olga, and I'm joined today by Matthew, our offshore rig expert. Thank you very much for taking the time to join us for our first webinar this year. We are delighted to have you with us and are looking forward to an insightful session. After a challenging 2025 for the offshore drilling industry, the deepwater floating rig market is beginning to show signs of strengthening demand as we move into late 2026 and 2027. Today, Matthew will be discussing the global drillship and semisubmersible market, including near and medium-term supply and demand dynamics, as well as the outlook for key regions. All of the data presented today is sourced from Esgian's Rig Analytics platform, alongside our own research and analysis. We would love to hear from you during the session, so please feel free to submit any questions or share your thoughts using the Q&A chat box at any time. We will address these at the end of the presentation, and if we run out of time, we'll follow up with you directly afterwards. Please also note that a recording of today's webinar will be shared with all attendees tomorrow, and we hope you find today's session valuable. With that, I will now hand over to Matthew.
Thank you very much, Olga. I appreciate it. And thank you, everybody, for joining us here today for our webinar, Floating Rig Market, What Lies Ahead. My name is Matthew Donovan, and I'm the Head of Rig Market Research at Esgian. Forward first to our disclaimer, and then we'll start off with some recent developments in the floating rig market, where we're seeing demand beginning to solidify into late 2026 and early 2027. Since October 2025, 32 new fixtures for floating rigs have been recorded, including exercised options. Start dates for these vary, but the majority of this work begins from mid-2026 into 2028, reducing the future availability in the market when compared to middle of last year. We're also seeing new tenders, pre-tenders, and plans continue to be added, increasing the potential future demand for floating rigs. And then most notably, on the 9th of February, Transocean announced that it would acquire Valaris in an all-stock transaction valued at around $5.8 billion. Moving now to our look at the Transocean-Valaris acquisition. The acquisition solidifies Transocean as the largest floating rig company. This transaction is expected to close its acquisition of Valaris in the second half of 2026. The combined company will have a fleet of 72 rigs, including 33 ultra-deepwater drill ships, 8 semisubmersibles, and 31 jackups. The combined company has the largest and most valuable offshore drilling portfolio. Should be noted that we are expecting some fleet rationalization will take place already. Both Transocean and Valaris have semisubmersibles that are held for sale at the moment. We do expect those to be removed from their fleets this year. The transaction expands Transocean's footprint in key regions of the Golden Triangle, the crux of offshore floating rig demand, the US Gulf, West Africa, and Brazil, as well as in the Mediterranean and Australia. The transaction also returns Transocean to the jackup market after it previously focused its fleet on the ultra-deepwater and harsh environment floating rigs. Of note is that the combined company will own the 6 remaining cold-stacked 7th-generation drill ships. These Valaris units were stacked more recently than Transocean's remaining 3 cold-stacked drill ships. The drilling contractors are unlikely to reactivate these units without firm contracts, but it will mean that the combined Transocean-Valaris will hold some of the few units able to re-enter the fleet in response to rising demand. We should note also that the transaction follows much other recent consolidation in the market. Recently, Noble acquired Maersk Drilling in 2022 and Diamond Offshore in 2024. In the jackup space, Ardes acquired Shelf Drilling in 2025. We've also seen a number of recent rig purchases in the floating rig market, including TPAO acquiring 2 Eldorado drill ships, Odfjell acquiring the semi-deep sea Bolster, and Saipem agreeing to acquire the drillship Deep Value Driller. This consolidation takes place in the face of a floating rig market that has been much more concentrated over the past decade. It's a consolidation concentrates ownership of a smaller pool of high-spec assets, following the extensive recycling that we've seen over the past decades. Moving ahead now, we're going to take a look at the floating rig market in early 2026. Take a look now at drillship supply and the current status of these rigs. And as I mentioned with the cold stacked units, few rigs will be available to join the fleet going forward. There are currently 92 6th and 7th generation drillships worldwide, including new build and stacked units. The 7 cold stacked units at the moment include 1 rig held for sale and expected to be recycled or converted. And the remaining 6 units are unlikely to be reactivated without a firm contract, will likely be held in reserve to meet future demand. Only 1 new build 7th generation drillship is expected to be delivered as a drilling rig. Keppel owns the undelivered new build Can Do and is considering both selling or bareboat chartering the units, though the company has said recently that it may wait for the market to improve before making a move on one of these options. Should note that no new drillship orders are expected in the near to medium term due to the expense and long lead time needed for a new rig order. New rig orders for a new drillship could cost upwards of $850 million to $1 billion and would take 5 years or more to be delivered into the market. So we're unlikely to see any new rig orders in our current status. Taking a look at the status of rigs at the moment, you can see most units are actually drilling out of the drillship fleet, and of the 14 drillships currently warm stacked, only 2 of those do not have a firm contract in place for future work. However, what we will see is some availability increasing in the near term, as around 17 units are expected to finish their current contract by the end of the year. So what we will probably have in the near term is some churn in the market as drillships come off contract and then start new contracts in late 26, early 27, or bidding on new work in that time period. Looking at some historical drillship demand over the past year, we can see activity stabilizing in early 26. What we saw over 2025 is floating rig demand that previously been projected for that year was moved into 2026 and 2027, a combination of capital discipline and cautious spending in the face of economic uncertainty, supply chain bottlenecks, and other delays. But as I mentioned, in the large number of recent fixtures we have seen and contracts that are currently under discussion, we are seeing much of that work for 2027 now firming up. The number of drillships under contract fell from 75 units in early 2025 to 64 units in September 2025, but since then has stabilized at around 66 to 67 units per month. Competitive utilization saw a recent peak at 86% in April 2025 and a slight dip as units rolled off contract and the follow-on work moved into 2026 and beyond. But we have seen utilization for drillships stabilize at around 80 to 82% since October 2025. With rigs rolling off contract and units waiting to begin work in late 2026 and 2027, that will lead to some near-term availability in the market. However, that availability begins to lessen by late 2026 as rigs begin recently fixed contracts. Looking to the semi-submersible market right now, there are 87 semi-submersibles, including both harsh environment and benign units worldwide. Of these, 13 are currently cold stacked and 2 are known to be held for sale and expected to be recycled or converted. Further attrition from these cold stacked units is likely, though some may be reactivated as needed. And of the new builds that you see there are 4 harsh environment rigs that are likely to be delivered over the next few years in response to market demand. Several of those are being marketed even before delivery. As with the drillship market, new semi-submersible orders are unlikely in the near to medium term for much the same reason. You've got a situation where it would take a large amount of capital outlay and a long lead time to bring a new build rig in, and we're unlikely to see any new rig orders, particularly while there are units that are still undelivered at shipyards globally. Now, of the 16 units, semi-submersible units currently warm stacked, around 7 currently have no future work lined up, and another are unlikely to work between now and their contracts starting in late 2026 and 2027. So like in the drillship market, we will see some near-term availability. And indeed, we're seeing 4 to 5 others will be rolling off contract by the end of the year. Moving on to the next slide now, we'll take a particular look at the harsh environment unit, which makes up a large portion of the global semi-submersible fleet. It's a smaller pool of rigs, leading to a relatively tight market for harsh environment units. There are currently 39 harsh environment semi-submersibles worldwide, including 3 cold stack units and 4 units under construction. And as I mentioned, at least one of those cold stack units is held for sale. Of the warm stacked units, only one of those does not currently have a firm contract in place. Another 4 are scheduled to come off contract before the end of the year. Now, since Q4 2025, there have been 21 fixtures for harsh environment semi-submersibles, including exercised options, adding around 12 years of backlog to this particular market segment. The North Sea remains the primary market for harsh environment semi-submersibles, and Norway has been bringing in additional units, while the UK is seeing muted demand due to partially to the Energy Profits Levy, which is likely to remain in place into early 2030. Australia is also an important area for harsh environment units, along with current and future demand in areas including Namibia, Canada, and the Falkland Islands. Looking now at some recent trends in the semi-submersible market. As we can see, semi-submersible demand has been flat at around 51 to 53 units over the past year, with competitive utilization stable at around 66 to 68% over the past several months. And what we're seeing there is kind of solid demand from typical regions, global demand there being buoyed by activity in the Chinese fleet and continued activity with harsh environment rigs in the North Sea, along, of course, with activity in South America, Mediterranean, West Africa, Asia Pacific, and the US Gulf. But importantly, with operator preference in many regions for drill ships over 6th generation semi-submersibles, we've not seen much of an uptick in the recent time periods in terms of semi-submersible demands. The exception really being the harsh environment units, where we've seen kind of continued strong demands during that time period. Moving now forward to a global outlook for floating rigs. Looking at the drillship demand forecast, we see drillship demand picking up in 2027 and beyond. In the near term, drillship demand is roughly flat over the first half of 2026, but many of these recently fixed contracts are starting to push that activity up by Q4 of this year, which is continuing into 2027 and remaining strong through 2028. And based on this activity, current tenders in the market that we are expecting to transform into firm demand over the coming months, we are expecting to see competitive utilization reach around 96 to 97% towards the second half of 2027 and holding that into 2028. As mentioned, discussions continue around long-term contracts for work beginning in late 26 and 27, and new tenders continue to be released. In recent weeks, we've seen a large tender from state oil company ONGC in India for floating rigs. And there's also continued tendering activity for rigs in South America and West Africa. Drillship activity, for the large part, remains concentrated in the Golden Triangle, so the US Gulf, West Africa, and South America. But other smaller areas, including East Africa, the Mediterranean, and India, are all projected to see demand rise over the next year or two. based on the current tendering activity we're seeing. In the US Gulf, we're seeing more flat demand, particularly in the near term, and that's likely to see some units leave the region to support growing activity in West Africa and other areas. South America remains a large driver of drillship demand. Petrobras, state oil company of Brazil, is currently discussing blend and extend contracts with drilling contractors for a number of the rigs that they have currently under contract, and it's being done alongside some remaining tenders it has for work at the Buzios and Mero fields. Petrobras has recently kind of reduced some of its potential demand, but activity from other operators in South America, and that includes international and local companies in Brazil and ExxonMobil in Guyana, as well as Total Energies and other companies in Suriname, will keep activity in South America steady for floating rigs as we go forward over the next several years. And in West Africa, we are seeing a lot of potential growth there, with requirements being trapped in Namibia, Nigeria, Cote d'Ivoire, Ghana, Angola, and other parts of West Africa. In addition to those West African areas, we also see upcoming demand in 2027 for floating rigs in Mozambique and other parts of East Africa. We also have a drill ship currently heading to Somalia at the moment for a well there this year. So we will see some East African activity this year and then continuing into 2027 with activity in Mozambique. So based on this activity, we are expecting to see that drill ship demand rise from late 26 into 2027, and then solidify at a much higher level in 27-28 than it is currently. Moving on to the semi-submersible demand forecast. After this period of flat activity, we are seeing some increased activity globally in 2027. Again, that activity is flat in the near term, then begins to strengthen on some expected increased activity in Norway and the North Sea and the Mediterranean, bolstered by stable demand in most other regions. As I mentioned, we've got roughly stable demand from the Chinese fleet. We have Chinese-owned units working for Chinese operators. Additionally, we're seeing some steady demand in South America, particularly with blend and extend contracts with Petrobras also being discussed for some semi-submersibles there. For the harsh environment fleet, Norway is the center for much of the expected demand for harsh environment rigs over the next several years, along with activity in Australia, Namibia, and Canada. So potential also areas for some increased activity there. And we did see recently rig fixed for a long-awaited project in the Falkland Islands in Latin America. So we're expecting to see some of those tenders for rigs in South America and India, also pushing semi-submersible demand up in 2027 and 2028. And as always, with some of these, timing on certain of these floating rig requirements does remain uncertain. While we do expect to see increased activity in 2027, some of these requirements may be pushed further into the future, particularly in some areas such as the North Sea. In the UK there, we've seen kind of less activity in recent years due partially to the energy profits levy and companies refocusing their activity elsewhere. We do see some P&A work in the UK and some other potential exploration work there, but the timing on some of these does remain uncertain. Moving forward now, we're going to take a little look at floating rig day rates based on some of this activity. As I mentioned before, we've got a supply. We will see some rigs leaving the fleet, and potentially we've got some cold stack units can be reactivated, but essentially we're not looking at big shifts in supply going forward, and we are seeing rising demand, so we should see increased utilization going forward, which can lead to some momentum for increases in day rates in 2027. Now, recent floating rig fixtures have changed little in recent months in terms of the day rates achieved. We've seen new fixtures for 7th generation units in the range of the mid 300,000s to high 400,000s, with 6th generation units around the low to high 300,000s over that same time period. Now, the near-term availability in both the drillship and semi-submersible market is expected to result in some flat day rates in the near term. So we have seen recently some low day rates in order for companies to obtain market share, but for the most part, most drilling contractors are holding at previous levels. And as the market tightens in 2027, we'll see day rates for semi-submersibles and drill ships expecting to start to trend upwards, particularly for the 7th generation drill ships. So those moving upwards again back towards $500,000, 500K day rates in late 27, early 2028. And that operator preference that we've seen globally for 7th generation drill ships results in greater momentum for day rates in this category. And moving forward onto the key takeaways from our presentation today. As I mentioned, floating rig demand is expected to strengthen from 2026 to 2027. As we've seen, Transocean's acquisition of Valaris creates the largest floating rig contractor, 41 floating rigs globally, so concentrates further supply in the hands of one company. And of note of that, as I mentioned, the only 6 cold stacked 7th generation drill ships remain at this time, all of which will be owned by Transocean post completion of the acquisition. New builds are limited, including 1 7th generation drill ship and 4 6th generation harsh environment semi-submersibles that would be likely to deliver over the next several years. So not a great deal of units entering the fleet. And again, we will see some cold stack units start to filter out. In the near term, again, availability remains in the drillship and semi-submersible markets as rigs continue to roll off contract in 2026, and new contract start dates trend towards late 2026 and beyond. As I said, most of the recent fixtures that we've seen are for activity beginning either in the latter half of this year or early 2027. And indeed, we have also seen options and contracts fixed for work beginning in 2028 and beyond. So we are looking at continued activity in that area. But in the shorter term, we will see some rigs roll off contract and remain idle, usually until starting their next contract as they go forward. And with that, we should see floating rig demand forecast to strengthen from 2026 into 27, with that demand remaining firm into 2028. Thank you all for joining us at our webinar today. As again, I'm Matthew Donovan, Head of Rig Market Research at Esgian, and we're going to move on to the Q&A section now. And just a reminder that if we don't get to your question during the Q&A, we will reach out via email with that. And we're also going to make a recording of this presentation and the slides available to the attendees. So yeah, feel free to enter your questions via the Q&A section of the meeting.
Thank you, Matthew, for sharing these insights. As mentioned, let's move to the questions. I can see we already have some in the Q&A chat box. So let's move to the first one. Matthew, do you expect any sort of increased footprint of Transocean-Valaris in Brazil, other than the consolidation of the fleet under one operator?
Mm-hmm. Yeah, I mean, we have so as you rightly point out, Transocean effectively will be increasing its footprint there with the acquisition of the Valaris units already working in the region. And I think with Brazil, we do have, again, blend and extend contracts being discussed with Petrobras and multiple operators, including Noble and multiple contractors, including Noble and Transocean. So yeah, I think there's a possibility for a lot of the Transocean units that are working there to remain there. And in addition to that, we do have Petrobras has tenders out for other units. So there'll be a factor in that as well. So there's a possibility for some increased footprint in Brazil. As I said, that's kind of where we might see units move from areas where we've seen lower activity like the US Gulf into potentially South America or West Africa going forward.
Okay, thank you. And what is your expectation on the outcome of Petrobras Renecon, particularly regarding demand in Brazil and day rate levels?
So part of this blend and extend contract has been, Petrobras has been very sort of conscious of costs and of day rates. And we have seen them, last year kind of scale back a little bit of their sort of future planned activity. So we will, and I think part of the blend and extend contracts is a way to, renegotiate some day rates in the near term, and that'll of course affect probably what they may decide to take from the current tenders. So I think in the near term, Petrobras is going to be trying to secure some rigs at sort of current day rates on the lower end, rather than risking renewing rigs at a higher rate in a couple of years.
Okay, and now moving into the third question. Does the average rate include long-term fixture sets, which would potentially skew current market representation in this chart?
Well, so yeah, so we're looking at multiple, obviously on those, it's an average, and that's kind of what we do is it's an average of the range we have. So obviously longer term contracts do tend to be on the lower end of that, and you sometimes see the highest day rates will be on sort of short term, almost spot work. I mean, that's when we'd previously seen units break that kind of 500K barrier in kind of 23, 24, that was generally on the short term spot ones. So I mean, if you think about these things as a range, with the shorter term contracts generally on the higher end of that range, and then longer term, you'll see drilling contractors will, sacrifice a little bit of the higher end of the range for a longer term and consistent day rate.
Okay, we have a couple more minutes, so I'll read the last question. Does the demand stack include options or just known firm work seen in active tenders and
no,
requirements?
It absolutely does include options. So that's including options in there. Now, obviously there's going to be some of those options will be exercised, some will not. Maybe some will be partially exercised rather than the entirety. But yeah, we are including those and taking those into account when we're doing our forecast demand. So options, firm demand, tenders, requirements, plans, and our own views on where the market will go as we go further ahead.
Mm-hmm. I can see one more question, if you don't mind. Do you anticipate any new build orders for floaters in the next 2 to 3 years?
I think that's really quite unlikely at this point. I mean, we still have sort of undelivered floaters. Companies have been working hard at making their getting their current fleets active. As I mentioned, it's would be really kind of prohibitively expensive to order a new drill ship right now. You'd have to start from scratch from the design phase. It's going to be multiple years before that rig, would be designed, built, delivered. Costs, we've seen costs from, quoted, above 850 million into sort of $1 billion on that. Most of the companies don't really have the cash reserves to build a unit speculatively at this point. And so I think, when we're still seeing rigs removed from the fleet, I think we're unlikely to see any new rig orders over the next couple of years for the floating rig market. There has been a few jackup orders recently, but that's kind of more connected to a Saudi Aramco building program. So but for the floating rigs, I think it's unlikely that we'll see any new rig orders going forward.
Mm-hmm. Thank you, Matthew. And
thank you.
Thank you for all attendees for today's webinar. As a reminder, we'll be making a copy of this presentation alongside the copy of the webinar recording available to you later this week. I can see some questions popped out in the meantime, so we'll address these questions.
Thank you so much for your questions, everybody. I will, if we did not get to you during this, I will reach out via email to you. So thank you again.
Thank you.
Thank you all.
Goodbye.